Don't you hate when you reach into the cupboard to get that fresh bag of chips, open it up, and realize that half of it is full of air? Well, this is a product of inflation, which is a super hot topic right now. We've covered it several different times. And better yet, this is kind of the dirty cousin by the name of shrinkflation. And that's what we're going to be covering today. So we'll start off by going over what shrinkflation is. And we're going to come up with a way that we can try and prevent and maintain as much wealth as we have today for the future tomorrow. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. I have a huge ask, a huge favor. If you learn something new or you get some value out of the video, hit that like button for me. I would definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. With that being said, shrinkflation, the definition, we'll hop into Investopedia right now, and we'll see that it is the practice of reducing the size of a product while maintaining its sticker price. Now, how this kind of came to me is that pasta that I was buying goes on sale for $1. The boxes are all the same. The packaging is all the same. But what these retailers are doing is they're reducing the amount of product that's actually in there. And it's very similar to the chip experience that we had. I hope all of you have kind of seen and noticed what these companies are doing. And it is definitely for a few different reasons. The first one is that inflation is eating away at these companies' profits. So what they're doing is they don't want to really pass those costs off to you on a visual. So if they can reduce the amount of quantity that's in there, but still maintain their margins, this is kind of one of the tricks and the way that they're plotting to maintain the amount of revenue. Meanwhile, making it seem to you, the end consumer, that nothing has changed. So what we'll do is we'll take a quick look at this National Post article here. And if you feel that you've noticed it as well, so have a lot of other Canadians. We see that nearly 3 in 4 Canadians, about 74%, reported noticing shrinkflation during the past half year. They're seeing this in groceries, in bakery, in meats. It's all across the board when you go into the grocery store these days. And, we think, what is a way that we can avoid this? Can we go and buy brand name product, President's Choice, no name? Yeah, that's definitely one way to do it. But what my suggestion is, or where I'm looking to go with this, is to take a look at what the inflation rate is actually sitting at today. And we're also going to take a look at what that money would be like sitting in a savings account. So the next chart I put together here shows Canada's interest rate, which would be the amount of money that you would receive if your money was sitting in savings in comparison to the inflation rate. So if you think about it, what my money can buy today can't buy me as much tomorrow. So what this is basically alluding to here, interest rate in blue, inflation rate, dotted line. We do see a little bit of correlation going back to 2018 here. And we do see a fall drop right here in 2020. And that's kind of where the pandemic and where the Bank of Canada decided to drop the rates. And what we see in this dotted line is the mass spike in inflation. If you haven't seen any of my videos, I'll link a few top about inflation. But what we do, if we take a step further back, this is the 5-year chart. We're going to take a look at the 10-year chart. We see a little bit more of a correlation here. We also take a step back and look at the 25, and we see something here that should be super evident, and that's the fact that the interest rates haven't passed 2% in the past 10 plus years, looking at after that 2009 financial crisis. Before, the interest rate was able to keep up with the inflation rate, as we see right here. And then we see the divergence between the inflation, although hasn't been bad in the past couple of years, is definitely breaking out to an upwards pattern. So what does this mean? This means, again, the money that I have today isn't going to be able to pay for the same things tomorrow. That is why investing is extremely important right now. If you have a savings account, you're making less than 1%. That's not going to be able to keep up with the 4% inflation we saw on the chart there. And if we look at an example per se, what I've pulled up is the S&P TSX 60. I believe the ticker is something like XIU, is an iShares product on the Toronto Stock Exchange. But we'll take a look what a 5-year return looks like for this S&P TSX 60. And if you're not familiar with what this means, it means the top 60 companies in the TSX. So you're diversified, and if you buy an ETF, they basically manage it all for you. And it's better than you going in and buying the 60 different companies individually. So taking a look at the 5-year return of just basically buying it back in 2017 here and letting it ride, you would be up about 44%, which turns out to be in between 8 to 9% annual return. So if you take that as a real return takes out the rate of inflation. Today you would get a 4% return effective. So we see that over the past 5 years, 44%. If we drop that out to a max, it gets us back to 2006, and that's roughly 77%. So it should do between 7 and 9% every year. Obviously, going back to the inflation rate, it's only breaking out this year. But the fact of the matter is, bonds, you're only going to make 1 to 2%. If you're lucky, GICs, the same amount. You really need to start looking at the stock market as an opportunity to maintain your wealth first and foremost, but also use it as an opportunity to grow your wealth. And stick to things. If investing isn't your, feng shui, or what you really focus on, is focus on ETFs that cover you and they diversify your portfolio over a number of names, whether it's the S&P 500 or it's the TSX top 60, or you're looking at particular, areas, whether it's, the bank ETFs, ZEB or HCAL. There's so many different areas in which you can take away the individual risk if you're new to this. But the fact of the matter, your money sitting in a bank is only going to hurt your wealth and hurt your purchasing power in the future, especially since these companies are starting to come and start reducing the package size in terms of the quantity that's actually in there. We can buy less today than we could yesterday. So I hope you enjoyed the video. If you're still with me, please hit that like button. I would definitely appreciate that. Let me know what your thoughts are down below. I hope you all have a great week in the markets. Happy trading.